So today, something absolutely incredible is taking place, and it has completely caught the AI and big tech droolers offsides. The NASDAQ is down more than 2%, while the Russell 2000, so the small cap index, is up 3.59%. And this is after small caps have underperformed large caps for 13 straight years. And we can tell that based on what valuations have done since 2011, which I'll show you now. You can see back in 2011, large caps actually traded for a cheaper valuation multiple than the small and mid cap companies in the stock market. But ever since then, this has completely flipped. Large cap multiples have exploded, while small cap and mid cap valuations and multiples have been flat, if not gone down. And the only other time this has happened in history was way back in the tech bubble. And that really sets the stage for a trend to change and revert back to the mean. Because from basically 2005 until 2019, that's when those small cap and mid cap companies actually traded for a premium compared to the large cap companies. And I believe we're going right back in that direction. But the reason this 13-year underperformance is so profound is because typically small caps actually outperform large caps. And again, that has not been the case whatsoever. You can see here the average annual relative performance of small caps to large caps is positive 285 basis points. So what that basically tells us is that every single year, dating back to 1929, small caps on average return an additional 2.85% relative to the large cap stocks. And if we look at rolling 10-year periods in the stock market, in 67% of the 10-year periods in the stock market since 1929, small caps have outperformed. And of course, that has not been the case since 2011. But to really understand why this is such a great opportunity, we also have to understand why the small caps have underperformed since 2019 or 2020. And we can actually go to Wall Street themselves. They tell us, flat out. We can go to State Street Global Markets who say, no, despite attractive valuations, they admit small caps have attractive valuations right now, but they say they're not buying yet because they are much more sensitive to an economic slowdown, have much higher cost of funding, and margins are likely to be squeezed more. Those are all fair points. You also have the fact that the large caps, the mega cap 8, Tesla, Amazon, Meta, Microsoft, Apple, the list goes on. Those companies have been in great position since the great virus crisis of 2020, where they were considered some of the very few that actually benefited from that pandemic happening. And then it just rolled right into this AI craze in the markets. Since late 2022, the same mega cap 8 companies, the large caps, have been grouped into this AI revolution. So for the last 3 or 4 years, the conditions to invest in large caps have been great. They've been phenomenal. And then you stack on the fact that small caps looked unattractive over the last 3 or 4 years. And it's no wonder large caps trade at such a multiple to small caps right now, despite what historical averages tell us. Now, it's true. The big problem with the Russell 2000 compared to the S&P 500 is that 45% of the debt inside of the Russell 2000 is floating rate. So it's susceptible to interest rate hikes. If the federal funds rate goes up, companies in the Russell 2000 get reamed. Whereas with the S&P 500, only 9% of the debt outstanding is floating rate. So they're much less impacted by increases in the federal funds rate. And then the even bigger problem is 75% of the debt in the Russell 2000 needs to be refinanced by 2029. And if the federal funds rate continues to climb, or the Federal Reserve threatens to continue to raise rates, obviously that means if and when these small cap companies refinance their debt, they're going to refinance it at higher interest rates, which hurts profit margins of these companies. This is in comparison to only 50% of the debt in the S&P 500 that needs refinanced by 2029. So there's a huge dichotomy there and difference between the small caps and large caps. It's no wonder it's been so unattractive to invest in smaller companies. So to put this really simply, anything that prolongs the higher for longer mantra at the Federal Reserve kills investors' appetite to invest in these smaller companies. But that also means anything that goes against the higher for longer mantra is going to benefit the small cap companies tremendously. And we just got evidence of this morning when we got great inflation data. Inflation fell 0.1% in June from the prior month, and the 12-month rate is now at 3% flat. This is very, very good news. So all of this great inflation news paired with the labor market weakening has investors in a frenzy about actually the Fed cutting interest rates. And again, when that happens, that is going to benefit these smaller companies tremendously that are much more interest rate sensitive. You can see based on this chart, and this is actually as of yesterday, so this is even more profound today, I'm sure. But the markets as of now are anticipating more than 425 basis point rate cuts over the coming 12 months. I'm sure this has actually moved to basically 5 rate cuts over the coming 12 months after today, but we'll just have to see how the data refreshes and what the data shows us after it does refresh. But this is why we're seeing such a clear rotation out of the large cap companies and actually into the small and mid cap companies, because all of a sudden investing in small caps becomes much more attractive if interest rates are set to come down. Now, I will say the markets have been accurate with this. You can see the red line is the large caps, the blue line is the mid caps, and the green line is the small caps. And this shows you forward operating earnings per share. So this is the estimated earnings that a company will make per share of common stock outstanding. The red line again is the large caps. You can see how since 2023, forward earnings projections for large caps have absolutely skyrocketed. Whereas for mid-cap companies and small-cap companies, they've actually fallen. So Wall Street analysts have estimated and projected, and they've been correct about this, they've projected that earnings at smaller companies would actually decrease. And you can see a very similar thing when we look at forward profit margins. Forward profit margins at large companies have gone up, whereas with small companies, they've actually gone down. But what we call the Fed put is going to make investing in small cap companies and taking on a little bit more risk, it's going to make that look so much more attractive. Because what the Fed put says is, the Fed's telling us right now, if the markets get concerned that we're entering a recession, or if recession indicators start to pop off and legitimize, the Federal Reserve will simply cut interest rates, which loosens financial conditions and adds liquidity to the system, which helps us avoid a recession. So that takes a huge risk out of the system as investors when we don't have to even worry that a recession might happen, because the Fed is going to do anything in their power to avoid a recession from actually playing out. And the Federal Reserve is very successful with this when they have room to cut interest rates like they do now. The only issue would come if the Federal Reserve has to cut rates into negative territory, but thanks to the recent rate hike cycle, we're not even close to having to worry about that. Now, if you're one of the investors that is concerned that large caps are in a bubble right now, and when that bubble pops, it's going to send all of the stocks down, I'll point you to the tech bubble. I don't have a chart for this, but you can look it up yourself. I have it in my notes. So from the beginning of 2000 till the end of 2007, the Russell 2000, so the small caps, returned 69% over that course of 7 or 8 years. The S&P 500 only returned 15%. So we've actually seen this play out in the past where large caps can significantly underperform. And if you're invested in the Russell 2000, you will make great money over the course of 7 or 8 years. So is it possible, if not likely, that large caps will underperform for a little bit here? I think so. But that's not a reason to sell your stocks or worry that small caps and the rest of the stocks in the market that have been beat up outside of the mega cap 8, it's no reason to worry that those are going to fall. We have historical evidence on our side that the market leaders can lag while the laggards lead, and the market continues to trend higher and higher and higher. So another reason that the Russell 2000 has felt a lot of pain is because structurally it's much more unattractive than the large cap companies. I mean, just look at this. The Russell 2000, this is a percent of unprofitable stocks in the index. The amount of unprofitable stocks in the Russell 2000 has absolutely skyrocketed, while the amount of unprofitable stocks in the Russell 1000 and the S&P 500 have fallen. So as a market index, investing in the Russell 2000 small cap index, it is way less attractive structurally. But I think that investors in Wall Street are actually offsides here, and this is why I'm so excited about this opportunity in front of us. We can look at the margin comparison, and this again is a lot of the reason large caps have outperformed. The S&P 500, which is the light blue here, the profit margin on these companies has soared, where the profit margin for the small cap Russell 2000 index has been pretty much flat. Now, the reason this excites me is because let's go back to this chart. The amount of profitless companies inside of this index has skyrocketed, but the margin of these companies has remained relatively flat. What this tells me is there are actually a lot of companies in the Russell 2000 index who have seen their margins also go up similar to the large caps. But because there are so many profitless companies joining this index, it has held down the average margin of the Russell 2000. And the reason this sets up such a great opportunity is because every small cap and mid cap company has been grouped together and punished together. So there are countless companies inside of the Russell 2000 that have seen their margins expand, their businesses grow, yet they have been punished with the rest of the index. This is going to be my goal over the coming month or so. I'm going to analyze, I hope, every company in the Russell 2000, put together an A list of companies to invest in, and I'm going to throw money at them. If you want to see that process unfold or get access to that list that I put together, simply join my membership, hit the join button located right next to the subscribe button, or hit my Patreon link in the pinned comment. I'm entirely self-funded, so your support monthly means a lot to me, and we have a lot of fun in the Discord server, and I think my membership pays for itself, and if you don't find value, guess what? I have a 100% refund policy, so it's zero risk to you to join the membership. Now, further making me believe that the market is way off sides with a lot of the small cap companies is the fact that based on the NFIB Small Business Survey, interest rates are actually small businesses' least concern. Only 5% of respondents to this survey say interest rates are their most important problem. Actually, the biggest three concerns from small businesses right now are inflation, quality of labor, and taxes. At the bottom of this, the least most common, most important problem, that was kind of a tongue twister, at small businesses is interest rates. To put this simply, I believe that Wall Street and the rest of the stock market is assigning way too much weight to the interest rate sensitivity of the Russell 2000 and many of the stocks and companies that make up the Russell 2000. I think there is tremendous opportunity here, and I'm going to explore it. And just one last note here before I sign off. Hedge funds have one of their biggest net short positions against the Russell 2000 on record. And that's according to data from Ned Davis Research. This is setting up for a life-changing opportunity, hence the title of my video. Now, if I go back to these pie charts, this was one of the biggest concerns and reasons not to invest in the Russell 2000 previously. Obviously, this is going to change if interest rates go down because the small businesses refinance their debt. They can actually refinance it at lower interest rates if interest rates come down. But an important note here that I want to make is the Russell 2000 arguably has more attractive opportunities in it. You see, half of the Russell 2000's debt is concentrated in 10% of the companies that make up the Russell 2000. So 200 of the 2,000 companies in the Russell 2000 hold 50% of the total debt amongst the entire index. And 33% of the constituents in the Russell 2000 have net cash. Net cash is when you take the amount of total cash a company has and you subtract all of their liabilities or debt obligations. That's when you come up with your net cash. 33% of them have positive net cash. That is compared to only 13% in the S&P 500. This is another aspect I don't think many investors are aware of that really makes the health of the small cap companies, many of them at least, much more attractive than the markets are pricing them for right now. Now, if you made it this far into the video, I'll reward you. I'll give you one of these small cap companies that I think is dramatically mispriced. FLUX Power. I just talked about this company yesterday. It's the reason the stock's up 14%. This is a $67 million company. Yesterday it was $57 million. I would just encourage you to go watch my video yesterday. It's basically a deep dive into this company and why I think it's such a life-changing opportunity. I'm going to do my best to find more companies like Flux Power because I think the opportunities out there, especially in the Russell 2000, are endless. It's just going to take a little bit of research, which again, I'll post all my research. I'll post my A list of companies for my members in the Discord server. But yeah, I highly encourage everybody to look into Flux Power. I can be wrong. I don't have a crystal ball. This is just based on my research. I've had incredible success in the past, but it doesn't mean I'm going to have success in the future. But with that, if you are new here or returning not yet subscribed, please subscribe down below. And I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.